All righty, guys. I should be live. Looks like I'm live. Welcome. Thank you for coming in. Let's see. I do see a comment here. My Discord link is broken. I will update that right after this meeting. Thank you for letting me know. So how are we all doing today? Is this are we having fun yet? Are we tired of winning? I don't know. It's been a pretty wild week, at least for me. Oh man. So this week we are going to be talking about when to buy the crash. And I called it a trader's guide to smart opportunism. We will see. We will see how smart I am in the coming weeks. But I think we got a lot to talk about, and this will be fun. I see some familiar faces in the chat. Stuart, thank you so much for coming back. I appreciate that. We'll have a good time here. Steve, your couch didn't deserve the hate a couple weeks ago. It's right over there. Don't worry. Don't worry. I did not get rid of it. Just up in the production value. Okay. All right. Enough fun. Enough fun. Let's get into it. So, hey Mauricio, thanks for coming in. We are going to be talking about a few things here. We're going to define a market crash. We're going to go over some historical case studies. There's been a couple great examples in my trading career and a whole lot more before. So we'll get into all that. We're going to go over to when to buy historically. We're going to use some nice parameters for you there, give you some nice rules of thumb, and we'll compare to the current crash and see if we're ready yet. We're going to talk about what to buy during the dip and after the crash as well. There are different sectors that outperform going into it, during it, out of it. And it is contingent upon the crash and the environment that we're trading. So we'll talk about that as well. We're going to talk about risk management, how we can keep ourselves safe, because as you guys all know, it is a scary time out there. And not just for you guys, for professional traders as well. It's scary out there, and we got to protect ourselves. So we're going to talk about common pitfalls we make, like not protecting ourselves. And we'll do some Q&A. And if we have time, we'll go over just a little free-form charting of what I'm seeing right now in SPY. And we can talk about all that, and I can take questions there too. So, welcome from Trader TV. Appreciate that. Thank you so much. All right. We got our beautiful little Ghibli version of this crash. It's a lot of fun, or panic-inducing, depending on which side of the trade you've been on, I suppose. Yes, sell low, buy high. That's the way to go. Exactly. All right. So the objectives here are we're going to learn how to identify real buying opportunities and not fake bottoms, not these kind of dead cat bounces like yesterday may have been. We'll talk about that too. What else? We're gonna talk about why these crashes can be generational wealth buying opportunities, wealth opportunities. As our buddy Warren Buffett likes to say, be fearful when others are greedy. Wait a second, that's not right. But be greedy when others are fearful. That's the part that matters. I should have switched that around in here. So myth busting, never catch a falling knife. And, there's that aspect for sure. We got to protect ourselves and make sure that what constitutes a solid bottom. And, there's sometimes you buy a stock because it's cheap and it gets a whole lot cheaper, right? So we're going to try to identify that stuff as well. There's always a balance here. So let's define a market crash first. We have some key metrics that are good to use. Usually, technically it is a 20% drop in the indices, and it generally happens fast. And that's where the VIX over 40 comes in. So VIX, if people don't know, is the volatility index. It measures fear in the market. When there are big moves, it makes big moves up. I should say when there are big moves down in indices, it makes big moves up. So the volume spikes are another big aspect because that shows a capitulation of selling. People saying, I can't take it anymore. I'm out. And usually that's a big blowout candle. And then often there will be a rebound from that as people sitting cash go, oh, wow, these are great deals. I got to take a nibble, right? So let's dig in a little deeper. We got some examples here. We got the COVID crash. That was a 34% drop in 23 days. No fun if you were long, trust me. 2008 financial crisis is even worse. I mean, it was stretched out over 17 months, but a 57% drop. With the COVID, I mean, if you were on your game and locked in, you could have bought that and then been green really quickly. But with the financial crisis, it was a bleed. It was a slide. Oh, thank you. You can't see my screen. I'm so sorry. We're gonna quickly go over the previous ones there. Appreciate that. There's the screen, and let's just walk back the other slides really quick. So intro, we talked about that. These are the objectives. We talked about that as well. But here's where we'll get started. Yeah, this is the COVID crash here, I believe. And 20% drop in the indices. We have the VIX at extreme levels and volume spikes. Thank you so much for letting me know in there. I'm still learning how to present. So thanks for bearing with me, everybody. So the key distinctions of a correction are the 10 to 20% drop, and you wait for the support. And, usually that's a pretty safe buying opportunity. That's what the market's been conditioned to do ever since the COVID crash and really ever since the GFC. So we have those 10 to 20% drops. They're usually not as scary. Usually, talking heads will be talking about buying opportunities and they won't be freaking out. And generally that's the right move, right? Then you got the crashes, and those are a little scarier. They usually happen faster. You get 20% drops real quick. Like we talked about in COVID, it was over the course of, what was it, 13 days, 23 days. And so those are like panic signals, and they can also be amazing buying opportunities, but you got to be sure you don't get hurt. Because I don't know, guys, let me know in chat if you've bought this dip too early. Maybe you bought the first out of 7 dips, and it's so easy to get demoralized, right? It's so easy to just say, okay, I was wrong. I'm going to wait it out. And then the market will, quite often rip on you and leave you behind. Let's see. I see that question, and we will definitely talk about that after. I appreciate that. I wasn't really prepared to plug all my stuff. I run a small community of mostly my friends, but I'd love to have people in, and we'll get you set up there. But let's talk about this stuff first. So historical cases, we got the 2020 COVID crash. So the bottom signal there was Fed intervention, and the VIX was over 80, believe it or not. It was very violent, and people were really thinking the world was ending. And to be fair, it was scary out there. There was a lot of moving parts, and it was really hard to see how the path forward was going to play out. So because of that, the market was reevaluating risk rapidly, and they realized that the multiples we were trading at just weren't sustainable. So because of that, we have VIX over 80, the volatility index, or the fear index, was spiking massively. Usually it trades between a 12 and a 25 handle, let's say. And yeah, the world's always ending, right? There's always something to freak out about. So it's important to use stats and use data and historical analogs to really kind of color your bias. The worst thing you can do in drawdowns in the market is to be too bearish, because you will miss the big move up, and that's where generational wealth is really made. So the best performers post crash were the Nasdaq and the tech index, and that ripped 120% in 18 months. So that's the generational wealth opportunities we're talking about. If you just held your nose and bought the COVID dip and closed your brokerage for a week or two, you were cooking and you never had to look back. So what else do we have? 2008 financial crisis here. This was the worst of it here. And the bottom signal was bank bailouts, so more intervention, and that time government intervention. And the S&P actually was at 666. So that's always fun. I always keep an eye out for funny handles like that. It seems like the market likes to react to them. Not saying we're going to get to 666 or 66, God forbid, but I am keeping an eye out for 420. So just saying. The best performers in 2008 were the financials, and they went crazy, plus 400% in 2019. So that's where I'm saying it's kind of contingent upon the environment that led to the crash about what we should be buying on the way out. So for this one, the risk was in financials, and then they got intervened, and they said we're too big to fail, yada yada, and all of a sudden risk was back on the table there, and amazing gains there. We have 1987 Black Monday. This was a gnarly one that I wasn't alive for, but I've heard horror stories about the trading floor back in the day. So the bottom signal was a 22% drop in one day. That is a yeehaw candle right there. That'll scare the heck out of anybody, let me tell you. And the lesson there is fast crashes often recover a lot faster. I don't actually have the fuller chart here. My trading view wouldn't go back that far. I had to pull it from some historical stuff, but yeah, needless to say, we're a lot higher now. So when do we buy? Let's talk about timing strategies. And full disclosure, this crash we have right now, but this was taken yesterday when I was finishing up this presentation. So I thought I'd have a fun little quip. When do we buy? Yesterday, but now I'm not so sure, and we can talk about that. So let's see. So yeah, let's talk about it. The signs that a crash is near the bottom include extreme fear indicators. So you can use like the CNN fear and greed index. When that's going off the charts, you can start getting interested. Oh, wow. Somebody started their investing journey the day after Black Monday. Chris, maybe you should be hosting this seminar. I might have questions for you later. That must have been wild. So VIX over 40 indicates a panic zone. Historically, shorting VIX over 40 never doesn't work. Question is, will you get liquidated first? So I'm not saying run out and short VIX. Not saying that. I might hold a little bit of SFIX, but that's between me and God. It's a very, very, very small position because I don't know what the heck is going to happen. Let's see. What else do we have? We have technical signals. We have when the RSI, the relative strength index, is over 30%, or sorry, under 30%. So just oversold on a technical basis. There will be algorithms buying that up and kind of absorbing down there, and bullish divergence as well. So there's a lot of ways that we can measure bullish divergences, and that might be actually a whole nother seminar topic. But we have the volume spike, we have the capitulation event. So that's that Black Monday, right? That 22% down day where everybody and their mother's saying, oh, I can't do it anymore. I don't know. We're going to zero. America's over. All that nonsense. So what we're really seeing there is a lot of mechanical unwind, as well as, just the risk, or, the risk of individuals with their mutual funds or whatever else saying, I can't risk it personally. But we're also seeing big hedge funds, big people holding big positions, just getting mechanically blown out, and they're forced to liquidate to, save their business, save their job, all that kind of stuff. So there are fundamental triggers. We have the Fed cutting rates or stimulus in 2020. We have the GFC, the intervention with bailing the banks out in the GFC crisis. We have potentially Trump pausing the tariffs. I'll talk about why I don't think that is the case, but that was the narrative yesterday when we were up 8% intraday, right? So something to consider. Somebody says they buy anytime fear and greed is under 18. There are these kind of regimes, we call them. I like talking about VIX regimes. So for example, when VIX is between 12 and 16, I'm looking to buy every single dip. I'm looking to buy calls. They're cheap. They go up. Things work. Once we get higher than that, I'm a little more risk off. Once we get over 20 handle, especially over 24, I'm looking to buy some SFIX. Usually we are a lot higher than that right now, and I'm not ready to load the boat yet. So we'll talk about all this. What are entry signals here? The biggest thing I think is staged buying. So these are just some examples. They don't have to be your rules, but some examples could be after a 20% drop and you have the VIX over 40, the fear spike, you can start nibbling. So for example, this is our week here. We had the capitulation here, or at least some capitulation, and I was buying under 500. So in the lower halves of these candles, I wasn't buying way at the very bottom because I was waiting for it to show some life, right? Because I try not to be a gambler. Let's put it like that. So we wait till there's some signs of bottoming. For me, 480. If anybody's been following my work for more than a week or two, they know that I've been watching 480 like a hawk. We did not actually quite tag it, but we started showing incentive for buying closely there. So that's when I started exiting my shorts, and I started accumulating long positions only in quality names and still very small sizing. Even now, I'm only I think about 15% invested right now. So buying a little under 500 for sure. And everybody's buying up here on this crazy day, right? We just came back and kind of healed some of these gaps. Doesn't mean that the bottom's in. Anything can happen, but I was selling up here personally, and I was reshorting. So it's been a good day for me, but this is not a bragging seminar. That'll be next week. I'll brag next week if it works. What else can we look at? The second entry might be when the market stabilizes above the 200 day. For us, the 200 day is way higher. It's about 575 right now. So I don't think that's necessarily the case here. If you wait for that, you might be waiting quite a while, and you might miss a lot of good opportunities. What you can look for is leading stocks and them holding the 200 day. So Uber is contesting his 200 day right now. CLS is another tech name I'm watching. That's dropped 50%, and it's holding at its 200 for now. Some names like that. We can talk more about that later. But yeah, there are good opportunities, and you want to look at the leaders on the drawdown. So you're ready to pull the trigger when it's time. So Fibonacci levels are another thing. We'll talk about Fibonacci levels, especially how they related to today and yesterday's price action. Very relevant stuff. But really quick, I'll say that I was watching, what am I doing? There it is. I was watching the 480 handle because that is a major Fibonacci level, the 50% equilibrium level between the lows of October 2023 and our all-time highs. So when it front ran that, I was very interested, and that's why I was looking long. And intraday today, I got out of my shorts intraday from the open. Basically, I took them short until we retested the 50% of this big candle. Okay. I'm hearing a little echo. Is anybody else hearing echo? Let me know in chat if it's annoying, and I can try to address that. Might just be on my end. So Fibonacci levels, we talked about that, and moving averages. Okay, no echo. Awesome, thank you. It's just me. Tim says slight echo. Give me a ping in Discord if there's anything I can do, but otherwise I'm a power through here. Wait for the price to reclaim the 50 SMA, and that can be avoiding the falling knife. So I actually don't know where the 50 SMA is right now, but in general, just reclaims of moving averages are a much safer area. Nomi says NQ has been holding above the 200 on the 1 minute and the 2 minute for the last hour. I love the short-term 200-minute moving averages. You'll hear me talk a lot about that too. They're a great trend indicator, on an algorithmic basis. There's a lot of algos that trade off them. So that's a great note. Good to know. All right, what do you not want to do here? You don't want to average down blindly like ARK in 2021, 2022. That can get you really hurt. You got to have reasons to take your spot. You got to have a good thesis, and you got to be willing to be wrong too. And so that'll be the next part. What to really avoid and what'll keep you safe. But we don't just average down blindly. It's just not a safe thing to do. That's gambling. Martingaling, if you will. Martingale his whole thesis was, hey, if you lose, just double down. And then when you keep doing that, eventually you'll win all your money back. Works great if you have unlimited bankroll, but I don't know about you. I do not have unlimited bankroll. I'm in the capital preservation industry or business. So we want to avoid dead cat bounces, and we want to wait for the confirmation. We talked about some of those signals on the last slide, and we can talk about some more too, and why I think this could be a dead cat bounce. And again, anything can happen. This is not financial advice. I will not be held legally liable if we rip 20% next week, because the market's crazy and there's a lot of headline risk, right? Any tweet from one guy can really move the market, and that's a scary environment for investors. It's a fun environment for day traders, but make sure you have that Twitter feed open. So what do we buy during and after a crash? So we have sectors that recover first are usually stuff like tech. They're very high beta. They like to rubber band and whiplash around. And consumer discretionary. When things are really oversold, people are sure that people aren't going to buy anything anymore, right? It's the end of the world. We're all going to be trading in bullets and tuna fish cans, and it's going to be a disaster and all this stuff. Those are things you hear at the bottom. Maybe I should add that to the bottom indicator signal. When everybody and your mother's freaking out and saying the world's going to end, it might be getting close, but not after yesterday. Post-crash winners from 2009 to 2020 have been the FANG stocks. So the big guys, we have Facebook, now Meta, Apple, Amazon, Netflix, Google, these real companies that have real staying power. They have a lot of levers to pull to right the ship. They aren't at risk of going bankrupt. They aren't at risk of not being used for the rest of the world. They're always going to be staples to some degree or another. So those are always safe bets. I'm long some Amazon. I'm looking to get long more Nvidia. I have a little bit there too. Not enough. I wish I was buying a lot heavier in the 80s, but it is what it is. Nobody can time the bottom perfectly, and if you do, you should be hosting this thing. Bitcoin, after the COVID crash, that did amazingly. So again, it's because sentiment went from very risk off. Bitcoin's a very risk sensitive instrument. And then all of a sudden risk was back on. We had stimulus on the table and the world was opening up and X, Y, and Z, all these reasons to be bullish. And well, Bitcoin responded. So defensive plays are good early. They keep you safe. They're insulated. People are looking for lifeboats and safe places to put money. Because one thing that people don't really realize, a lot of people, is that most money doesn't enter or leave the stock market. It just gets shifted around. So when risk on stuff goes down, they're looking for a safe place to put their money, and often that's in defensive sectors like utilities or healthcare is a great example right now. We have UNH doing amazingly, and that is an example of something that isn't very affected by tariffs, if at all. And it's something that people are always going to need, maybe more if things get bad. So that's always something to consider. We talked about XLU, also gold as well. Gold is a very good risk off instrument as well. When people are losing their faith in either the dollar or in tech, stuff like that, they want something safe. They want something real. They want something shiny. It's a little bit different this time because gold has ripped so hard all year. So I actually haven't checked the gold chart in the past day or two, but I wouldn't be surprised if it de-risked with the market and ran with the market, just because it's trading like a, not necessarily a risk on asset, but it's going up when the market's going up. So we got the recovery phase. You can look for things that have been really beaten down and that are very cyclical. So something that's really beaten down is like something like small caps, like IWM. That did amazingly if you bought after the past couple crashes. And semiconductors, they're very cyclical. They when they get moving, they really move. I am not sure if I'm ready to buy semiconductors, and if I do, and this is the theme for my whole dip buy spiel, always buy quality because you don't know if it goes down more. And I don't know about you, but if for my long-term port, I'm not minding if something that I really believe in is giving me a discount. I'll buy more, So that's where loading in tranches in set amounts, not full porting anything, not trying to time the bottom. That's where you'll do really well. Maybe your first buy, maybe it drops 20% after that, and maybe that's your second buy, and maybe it starts moving up, and that's your third buy. And then by the time you're like half invested or whatever, you're deep in the green and you feel safe. So yeah, it's always important to preserve capital in these environments because anything can happen. So we kind of got into that right then, but let's dig in a little deeper on risk management. We have position sizing. Never go all in. Maybe you start with a 25% position. I started a lot smaller. I started out in 5%, then I loaded 10% under 500, another 5% when we got that news on the way up. But then I was loading shorts up here, and I took profit up here on that 10% or that 5% that I added here. So what you can do is if you think that we're bottoming, but you're not sure, I told people in my community, like, okay, I'm getting long here. I think we're going to rip. But if it comes back down here, I'm going to stop out and just hold that cash until I feel better. Because if I'm right, and this is a V bottom, because it sure felt like it yesterday, right? I mean, I don't know about you, but that kind of move, even me looking back on it now, I'm like, I don't think so. But during it, I was like, heck, I got to have some money on the table, And that's where FOMO will get you, even with experienced traders. I mean, there are many traders far more experienced than me. I've been doing it about 6-7 years, but it sure got me on some level or another. But the thing is, I don't fully trust myself. So I still add hedges. Those didn't look good yesterday. They look pretty good today. I added more hedges this morning when I saw the overnight price action looking so weak. So yeah, it's important to be flexible. It's important to have contingencies and to respect your stops, because we pay those stops. It's like a bodyguard, right? We pay them to keep us safe. Because I'll tell you right now, no trader has ever entered a trade because they think they're going to be wrong. We all think we're going to be right. When we hit the buy button, we think we're right. Just psychology, right? Nobody thinks they're wrong. But a lot of times we are. The best traders miss 3 out of 10 shots, right? And it's important to remember that, especially on days when the candles are so big and the volatility is so wide. And it's scary, and it's easy to get caught with either FOMO or, sky is falling syndrome. You gotta thread the needle, and that comes with time. So if you don't have that, don't worry, but just try to focus on building that skill set is going forward. So yeah, the stop loss rules. If you're buying early, set wide stops, because hey, like I said, it could go down 20% more. If it's a really high quality thing and you don't have a big position, you can afford that, and maybe that's a good thing. Maybe you're like, hey, I get to buy more cheaper, even better. You got to have some stop though. You can't have zero or hero. It's easier, and maybe you don't have to have a stop on like really high quality blue chip stuff. Like Nvidia's not gonna go to zero. I'm telling you that now. Apple is not going to go to zero. Google's not going to go to zero. A lot of the small cap stocks could very well go to zero. So just keep that in mind and know what you're buying, right? And hedging, buying protective puts and inverse ETFs on the indices, especially when we're in a downtrend and we get these big pops, and you don't want to sell your longs because you think we're going back to all-time highs, right? But you don't know what's going to happen, and we're overbought short term. That's a great time to either buy protective puts on the indices or on your individual stocks. You can do the math with that. There's a lot of good resources out there, but one put will usually roughly protect 100 shares of something. And, this basically allows you to use options as they're actually intended, which is for protection. I know we all like gambling on them, but their actual job is for hedges, for protection. A small amount of capital protects a large amount of capital, right? So that's great. I like inverse ETFs when VIX is this high because they're not as affected by IV. It's not like the same as buying a bunch of calls or a bunch of puts because we are still pretty low down here, and you kind of gotta see good follow through to get your money's worth often in these environments. So I'm a big fan of the inverse 3 times leverage ETFs. So I've been on these pops buying SOXS or buying SQQ, stuff like that. If you're a little bit riskier, you could do UVXY. That's 2x VIX. But man, if you're wrong on that, whoo! I was looking at my small UVXY hedge end of day yesterday, and I was just, holy moly, I'm down 25% on the day or something crazy like that, So size small, keep everything in mind in terms of contingencies, and most importantly, have a plan. I put this one in bold because I think it is most relevant right now. Hold cash for better opportunities. You don't have to trade this if you don't want to, because honestly, it's not that fun. I feel like I've aged about 5 years in the past 2 weeks. So we got somebody making a bunch of money in UVIX today. Congrats, brother. I'm with you. I'm with you. The UVIX actually tapped its 200-day moving average and ripped like 30% off of that, 37%. So I'm not saying do TA on VIX. I am saying I do TA on VIX. Take that for what you will. But here are some common pitfalls. The FOMO buying that we've been talking about. If you bought on the 12th in 2020, market dropped another 10%. Again, maybe that's a good thing for buying opportunities. But if you're all in, it can be really scary and hard to hold. And you're gambling at that point, right? Don't all in. It's not worth it. I will tell you this as somebody who's over the years all in way too many times. And sometimes it works great. Usually I take a small loss because I'm scared and I have my whole port. Obviously back then it was a lot smaller of a port, so it was easier to be a cowboy, a gunslinger. But even then, when you're down 5% on the day and your big port, you're like, oh man, I was wrong, and I gotta bail before I'm down 50%. And then often my read was right, but it didn't matter because I got stopped out. So sizing correctly will prevent you from these kind of really unfun situations where it comes down, snags your big stop because you were oversized, and then the thing you thought was going to happen happens without you, And all you could do is calculate on the napkin, like, oh, I could have been up this much. I could have been up this much. Well, if you sized correctly, you could be up a nice chunk instead of down some. So panic selling. There was a good example for Bitcoin where, if you were selling at 30K in 2020 or 2021, I don't know what I was saying here. Actually, all I know is rereading this, like, what was I even thinking when I wrote this? So the gist is, if you're sized correctly, you probably won't panic sell. You can respect your stops and just, trust the process, so to speak. Hopefully your process is good. We're trying to work on that here. So ignoring macro trends like buying tech in 2020 before Fed hikes, that can get you in trouble, So we got to keep in mind the bigger picture. We always got to keep in mind the bigger picture. And right now, I'll tell you, the bigger picture is tenuous at best. We have like 3 factors which are driving negative growth with the tariffs, which I know we have a pause on the extra rates, but they're still big tariffs. 10% flat tariffs is nothing to sneeze at. So we got that. We've got the new immigration reform that's going to tighten our labor market. We'll have fiscal drag because there's less people paying into Social Security and taxes. The fiscal policy as well. We're still kind of feeling the inflation and everything from stimulus. And there's just a lot of factors which could see a sustained bear market happening. And when you have a sustained bear market, you will get candles like this. People who are over short, over leveraged, getting liquidated in the market, running it up on them and just jamming big bull candles down your throat. Like, oh my God, it's going to keep going. It's up 5%. It's going to keep going. I got to get out. I mean, heck, I wasn't very short yesterday, but if I was, I was a little short. I didn't do that well yesterday. It was a green day, but not a huge day, like for a lot of people, because I was kind of balanced, and I was like, oh goodness, do I sell the shorts? I can't sell into this. If I was a big hedge fund or a CTA that was pressing my luck short, I would be forced to sell if I didn't have those longs to keep me safe. So Yeah, just something to consider. Bear market rallies are vicious, and everybody in the world will think this is it. This is the bottom. Time to load the boat. And then you have a day right like this that it's an easy 4% down, and sure, we bounced at the end of the day. I'm not saying that all hope is lost. I'm still relatively agnostic, but nobody was expecting that yesterday, right? So the best entries, the best trades feel terrible when you enter them. Like, I'll tell you right now, if you shorted yesterday at close, I didn't. I shorted today at open when I felt a little safer. If you shorted yesterday at close, you were miserable overnight. If you weren't watching the futures, you were miserable going, oh my God, why did I do that? It's terrible. Made a hefty profit in one day. Same thing if you were buying down here and you didn't have a big game plan, when you lost 500, the big number, and we were still just drilling down, that was tough to buy. I bought some and it was tough for me. That's why I sized so small, but it was a great trade, and that's often the case with these because, at some point it's got to stop. We got to have limits. We got to have stops and everything, but it's important to keep in mind the good trades in these kind of environments won't feel good when you enter them. So we can have a checklist like, is VIX over 40? Is volume spiking? Stuff like that. Feel free to refer to this recording on YouTube. We talked about that in the earlier slides. And do your own research as well. There's a lot of metrics you can use, but I just picked a few that I use personally. So I think we'll take a break here, and I'll take some questions. If anybody has questions, feel free to drop them, and I'll take a moment to drink some water and read back through the chat. And thank you, Tim, for starring some of these. I'll work through them. Oh, and thank you for all the love, guys. You're the best. Appreciate y'all. Okay, Spencer, my buddy Spencer, what do we got? Why does the market feel like it just keeps spiraling into worst volatility? More retail traders trading more frequently? I won't say that's not a factor. What I will say is that we do not have clarity on the path forward through this. Even though we have the 90-day tariff stuff, it's still, the market is showing me that there is still a lot of volatility. And one thing that I want to see in a bottom or after a bottom is volatility contract, right? We want to see less volatility on the way up because people are less panicky, right? We are not seeing a massive decrease in volatility yet. I don't know if anybody was day trading, but those candles were big. They were scary. They were mean. Not as mean as they were on this leg down, but still there's a lot of shake and bake going on, as I like to say. And because of that, I'm not ready to call a bottom yet. So that's kind of where I'm at. So when you spiral into worse volatility, and even if you get volatility up like yesterday, it doesn't necessarily mean you're out of the woods yet, So what else we got? We got David Andrews saying inflation came out better than expected, but the data lags behind a month and tariffs started in April. So wouldn't that mean that we see the real inflation impact on May's inflation data? So this is a little outside of my wheelhouse. I won't pretend to be an expert, but yes, that is my understanding. I'm going to be watching closely on the next print. I don't think this print is really important at all, to be completely honest. And I think the market action reflected that, right? Nobody really cared about CPI today. It was a pretty big nothing burger. Nomi says futures are about to look like a seismograph in California when the market opens back up this evening. Let's see. It'll be fun. It'll be a lot of fun. As a California native, yeah, we got some shake and bake. We'll see how that turns out. All right, Mean Gene, can you speak on the influence of QT in this environment? Last time we had a crash like this, QE had a big impact on recovery, especially for Bitcoin, but also the markets and real estate. So again, this is out of my wheelhouse. I'm a crayon eater. I'm mostly a technical analyst. I'm learning more about macro as I trade different environments over the years, but I will never claim to be an authority on this stuff. Let's see. Last time we had a crash like this, QE had a big impact on recovery. Absolutely. So I think that the situation we're in now is a little tricky because I think that in a lot of ways, Trump has kind of handcuffed Powell in terms of policy. I feel like he doesn't have as many levers to pull as last time. I'm just not sure about the details enough to speak on them too much. I am going to do some homework this week because this is raising some questions that I want to learn more about. So hopefully I see you back next week, me and Gene, and we can talk more about this. We got Nomi again. Thanks so much for your participation. It means a lot. MU should benefit from all of their competitors having moved to Taiwan years ago, Kingston being one. MU kept their plants here and get their silicon from the valley. Sounds like you know more about this than me. More stuff for me to look into this weekend. All right, our buddy VSync, which is why short sellers though malaligned and underappreciated are critical to a two-sided healthy market. Absolutely. When you have economies banning short selling, I don't think that's good. So I am going to skip a few questions that I don't feel like I have a good handle on, like the fundamentals of chips. That I'm a tourist in that space. I'll be completely honest. I just look at the lines. I would recommend checking out Jay Arlington. He is an amazing resource and my go-to for semiconductors. He has a Twitch stream. Mike Dundee says people don't use trailing stop losses as much. This is totally preference based. I am a big believer of trading the chart and not my PL. So when I say that, I mean I am less likely to put a trailing stop on if I think that it'll likely get tagged if it's over a key level or something. So I'm more likely to pick my entry based on its location relative to a key level. So say we come down, we knife through support a little, then we reclaim it and start pushing up. I will be getting long and putting my stop under that key level and probably more like under that swing short. So if I had a trailing stop, price goes up, it goes up with me, comes down, takes me out. But, it does depend, if it's a big position, maybe you put a trailing stop on part of it, but I would rather have my idea be proved wrong and not have my stop get run and then off to the races again. This is all personal preference. This is just what works for me best. Andrew Wong, which leaps should I buy? I am not going to give financial advice, my friend. What I will tell you is that I think that leaps, the IV is still pretty high right now. You can mitigate that by doing leap spreads. So for example, I like Hood. I am personally long Hood. So somebody I know bought, I think 45-50 leap spreads. So that's something you can model on OptionStrat or a website like that. And you can kind of see the difference about how volatility can be mitigated through a spread strategy, a vertical spread strategy. And it's kind of a play on convexity. So like on the move really working in your favor while minimizing risk. I won't give specific stocks that I'm saying, go buy this, but I'll tell you what I'm looking at. Let me pull up my notes here. I'm really liking high quality US equities like Microsoft, Amazon, Uber I'm a big Uber bull. It's basically at its 200 day. I'm long from 65. UNH, I wish I had more. I have the tiniest position off the 200 day because I wasn't sure, but that's an amazing quality stock. Hood, like I mentioned, I love. Reddit, I'm long from about 90. I like that. But these are all small positions, right? These are all small positions that I'm kind of expecting to go down again. So definitely not saying load the boat. A few more, NVIDIA, of course, and CLS I really like. So just some names to keep an eye on. All right. What else we got? Mean Gene, again, another question about QT. I'm going to get back to you next week on this. I need to do some homework. Honestly, I just don't feel confident enough one way or the other to say. My gut is that if we had to pull the lever and do QE earlier, it might be perceived as bearish by the market. Like things are falling apart and it might not have the market reaction you'd expect. So that's all I'll say right now. I need to bone up on my QE knowledge and go through some historical analogs and see what the closest scenarios are that match this situation, because it's quite a unique situation. All right, David Andrews, question: since inflation data lags a month behind and tariffs went into effect April, did I already answer this one? Wouldn't that mean the real impact of CPI will come out next CPI? Yeah, absolutely. So I do believe that is the case. All right. What if you DCA down and your average cost still looks pretty bad? I'm sorry to laugh. I've just been there. Trust me, I've been there. When do you exit and cut your losses or wait? So this is, it's contingent on the stock. It's going to depend. You can look for key levels. You can look for areas where, like, if this holds, then good. If not, then we have a lot of room down. I will say that it's important to know these levels before you get into trades. I've made this mistake. I'm not saying I'm perfect, but if you ever feel like, hey, I just don't know what's going on, I feel like the bottom could just keep falling out and going out and going out, you can expose, or you can decrease risk in the same way that we're increasing risk, on the way down, DCAing, and then hopefully increasing risk on the way up as it starts to work too. You can decrease risk if a stock is not working how you'd expect it to. That's a rule that has saved me a lot of money over the years, where, I'm always sure I'm right when I enter the trade, but if it stops doing what I think, maybe I'll take a quarter off, maybe I'll take a half off. If it really, really messes with my plan, maybe I'll just cut the loss. I think it's really important to not worry about the percentage you're down and just do what is right based on the information you have. Will that sometimes mean you cut it and it goes back on you? Yeah, honestly, it will. And that sucks. I'll be the first to say that sucks. But I do think it's really important to protect yourself and preserve capital. That's our biggest goal as traders, to keep safe, preserve your capital, and then you'll catch the next big trade. Can't catch the next big trade if you got no money. All right, Mauricio, we closed over 5,300. Great level neckline. What do you think about sellers lacking continuation and going long tomorrow if we stay above? It's something to consider. I'm gonna keep this in mind when I open the chart here in a sec. Actually, why don't we do that now? I'm gonna hop over to my SPY chart. All right, looks like you got my SPY chart here. So here we are on a daily level. As you can see, I'll take my little victory lap here. This was the move I was projecting. I projected it right here. Sure got there quick. I was looking for this August low, this capitulation, and this gap to fill. So we got that. We swept under here. We cleaned all that out, and we reclaimed. This is relatively constructive. Let's look at the daily candle. It's a hammer. It's a hammer inside of this big trading range. So there's a few things. I will not be actually fully bullish till we get over the tariff announcement level. And this whole thing is at one big bullish order block, as I would call it. And when I say that is price went down and it reclaimed. So you can think of it as like a big wick on the weekly or on the monthly chart. So we already have quite a wick on this monthly chart. It goes down to here. Kind of hard to see with all my scribbles. Apologies there. Let's see. I can hide drawings. Yeah. So as you see, big wick here, big wick. And this is why I was looking for the 180 or the 480 handle, by the way. It was the swing high here. And if we look on the yearly chart, multi-year support. So we didn't fully tag it. And I don't know. Something tells me we could fill that in a little better and maybe test in here a little more. And even 420 is only about a 50% retrace of this zone. I'm not saying we get there. I am saying I'm kind of looking for it. So those are some things to consider. Let me pop my drawings back on. Apologies for the clutter here, but in general, I think this could very well be a big bear flag. We came up and healed some of these gaps. We popped through this one and we couldn't push much into this one. So I think in the futures, they did fully heal it and then price immediately went down. So whenever we have gaps like this, market loves to fill gaps, but it's important to kind of to watch the price action after the gap fills, because it's kind of like the gap is a magnet. So SPY had a big old magnet up here and price came up to it, it tagged it, magnet disappeared. Now what happens? Do we surge above or do we drop? We dropped. I'm still bearish. That's kind of how I'm looking at it. I will say the daily stick is not bad. It was a good wick. Let's go to the hourly, see a little closer. Couple ways to look at it, right? We have this daily bear flag potentially. You could argue that this is a bull flag inside of it for a next leg up. So if we zoom in a little bit more, 5 minute, you can see my daily trading plan here. I got short when we broke pre-market highs or pre-market lows of this range, short around here, and came back up on me, added a tiny bit, but I was kind of scared, to be honest. I won't lie to you, but I trusted the plan. It couldn't break above. My stop was above here with the added stop above this swing high. And then we got the nice move down and I got out at this 50% fib. And that's a 50% fib of this range. So got out of about 3/4 of my shorts. I'm still holding a little bit, but I also got long TQQ in here when we reclaimed on this candle right here. So was a little red here, but no biggie. Came up, took a little bit off, but I'm still holding it. I just have a little bit on both sides. I'm just kind of playing the edges of ranges, right? Just whenever I see a good trade, you know. And so then I was noting, okay, this looks like a bear flag. Each one of these pops gets sold off, and we have the rounded top. So we came down. I was not expecting this at the end of the day. So I'm trying to keep my my options open here. I won't say for sure what I know is going to happen because I don't know. I will keep trading what I see, and I think it's really important that we watch overnight price action. Like yesterday, it was very clear. Oh man, overnight's weak. Overnight's weak. Overnight's weak. This candle was very telling to me. We tried to go and couldn't. So that's why I was watching for a break of this range to go long, or go short, I should say. So in terms of 5,300, let me pull up. I'm assuming you're talking SPX levels. No, you're talking ES levels. Okay. 5,300. Yeah, I have a level right about there. You can nudge that on up. And that is where, yeah, we have this wick up here. As you can see, it's a very valid level. I think this is right about 525, which is the level I'm watching. We can zoom back a few days and yep, exactly. So yeah, this is a very key level, this little zone here. What you can do is you can take the wick on the hourly, go like that. And it's kind of a little zone for us to watch. It's also the 50% retrace. So I would say if 5280 to 5,300 hold, then you're probably good to go for a long. Just keep an eye on that zone. Keep an eye on that zone. If it's valid, this could be a bull flag, right? And we could be seeing a cup and a handle here. All right. Thank you for the questions. Let's see what else we got. Oh, you're very welcome, Jay. I appreciate you coming in. Keys, do I have X? I have one share just to keep track of it. I have one share because I missed it. I have one share at 42, and I am about, looks like 3 or 4% red on that. I am not losing sleep over it. I think the deal goes through. I would like to buy more at 40 if that holds. Wish I saw it this morning. It's hard, man. I've been trading this back and forth, and it's a chaos chart. I don't know what the heck to make of it. As you can see, my schizophrenic lines here. I've had a lot of feelings both directions as it looks like it's setting up for a breakout, then fails. It's hard to trade these news-based stocks. I will be the first to say it. Is it worth using ATR for a stop loss in this situation, or would that not be worth it due to volatility? I love ATRs. I often use them for stop losses with the caveat, which I think you're honing in on here, that when daily ranges are this wide and when volatility is expanding, those ATRs become less and less relevant because they're tracking, they're looking back through a period which is less volatile than the period likely going forward. So I'm not saying don't use it, but what I am saying is that take it with a grain of salt. In general, and especially in bull markets, I love using ATRs both for stop losses and for take profit targets, especially take profit targets. That's my favorite. Great question. All right, Ryan Stolt, do you trade individual stocks during earnings season? And if so, do you prepare for each day's earnings announcements? So I am not a earnings trader per se. Sometimes I will play around if it's a company that I know a lot about. For the most part, I am a tourist when it comes to individual names. So what I do is I wait for earnings setups called post-earnings gaps. Let's see. So this is one example where we have the earnings result on Okta here. It pops up, and then I'm waiting for consolidation after that. And yeah, I have it all marked up here. Post-earnings gap swing low, quarterly support, and 52-week high. So I think I got long in one of these days when it was kind of tightening up. And I took some off when it went over here. Then it failed and I got stopped out. So not the best example, but this is the kind of setup I look for, post-earnings gaps. And you can Google that, post-earning gap setup, and it'll give you some more parameters. It's a really good system for trading these. So then you can catch a piece of the move. You won't catch all of it, right? But you can have some skin in the game if a company has good earnings reaction without just chasing it, because chasing it'll get you killed almost always. If you're buying up here, you're taking a hefty drawdown. 7% before you see green. So just something to consider. Thank you for the question. Your guesstimate, AI Alicia, I hope I'm saying that right. Fun name. Your guesstimate. How long would the bottoming take, doing sideways, etc.? And what indicator would you prefer to refer to for giving you more confidence in the early phase of a bull recovery? So that's a good question. I think that it's not really a one size fits all thing. So what I want to see is capitulation volume. Let me pull back SPY here. We have high volume, but it's staying high. I want to see a big old spike. I want to see a big old spike on red. And maybe I got this level down here, the meme level. I don't know. I'll zoom in case anybody wants to see these. We got unfilled gaps around here. We got the meme level. This is a big one for me though, 480. So maybe we knife under here on high volume, and when it reclaims, I'm looking there. I'm a big volume trader, so I'd say if I have to pick one, it would be the capitulation volume. And I'm just not seeing it yet. Yeah, and I'll be completely honest. I think that we may be in for a sustained bear market, and in that case, it might be push down on high volume, rise up on lower volume, but still high volume, push down more, this kind of mean chop down. So I don't know if anybody was trading in 2022, but it was tough. A lot of people were calling a lot of bottoms, and a lot of people got blown up. Mean Gene, what is my strategy now? Are you waiting before making any moves due to market uncertainty, or are you mobilizing capital? Great question. So I talked about it a little bit. I'll talk about it a little more. I was a buyer these 2 days under 500 when it showed life, because I just thought, hey, we are down so much so quick. A lot of names that I've been wanting to buy for months and just couldn't justify pulling the trigger. Now they're coming back to reasonable levels. So I can pull up a few of those, like Uber came down to this old level I was watching when it reclaimed 65. I was a buyer there, just nibbles though, not loading the boat. Reddit is another name that I love. I think they're high quality. I think they're going much higher. We filled the gap very precisely here and post a kicker candle, which starts red and closes at the high. And that was a very bullish sign for me. So I got long somewhere around here, probably like 92. I got to check my cost basis. Trimmed a tiny bit because this felt excessive. And I was watching this high right here. When we got close, I was like, hey, good enough for me. I got too much stuff to watch. I'm going to take some off the table. Looks like it tagged it pretty precisely. I think I got out. I think probably like 110. But I still hold a few, not a ton, small position. So my overall strategy is buying high quality names when I think they're oversold and when I think that they're a level that I could defend, right? So I can defend those entries. I can sell a little when it goes up. If it comes back down, I'll buy a little more, and I'll keep fighting my way to get my cost average where I want it and my position size where I want it. All this while, I am selling rips because I think we are in a sell the rip regime, but I am selling rips on indices. I'm selling rips on garbage stocks that I don't believe in, and I'm using the capital that I harvest to buy more stocks that I do believe in. That's my strategy. All righty. Let's see. Kevin says, what were some indications today that made you feel today was a short? I know you mentioned the price action overnight, but were there other indicators or analysis that justified the short today? Oh, you guys don't know. That's my handle on Discord. So yes, let's talk about it a little more. I mentioned what I was looking for, but I'll run over it again really quickly. So weak price action overnight. And then this candle in here, it was a look above and a fail. And then right before market open, we started de-risking. So already I'm biased short. We had a big move up, showing weakness already. I know people were chasing. I know because I was not going to chase and I had to close my brokers. I couldn't look at it. I was feeling sick. I was like, oh, I'm 15% invested and the market's up 9%. Felt terrible. Felt a lot better when I opened it up in the morning and saw, oh, wait, we're de-risking here. And so, yeah, when we broke this pre-market low, that's when I really started shorting. And then I built into that position through this kind of range. And then I got out here. So pre-market lows being broken are a very good indicator of a trend for a day. Doesn't mean it'll trend the whole day. We don't get that many trend days, although a lot more recently. But that is what I would say if I could condense it to like a few things. Pre-market low got broken and my bias was already short. All right. LP's Little Adventures. How do you deal with stop loss hunters? This is a great question. It's a great question. So how I deal with them is I wait for candles to close. I give myself enough room to basically wait for some meaningful time frame candle to close, because stop loss hunting is very real. Algorithms love sweeping ranges efficiently and just shaking the lunch money out of your pockets. It's mean, but it's just good business, as they say. So to prevent that, say, let's see, what's a good example here? Say I'm short in this area. Say I didn't get out here. I did because it was a major level, but this was a stop loss run or a stop run, right? So you only had to wait for 5 minutes to see the close of this candle. So I think it's really important to, if you're a day trader, look for 5-minute closes or 15-minute closes. If you're a swing trader, hourly closes or 4-hour closes. And basically, we don't really care too much what happens on the the movement of a candle inside it. What really matters is the close relative to the open. That's what actually that's where the rubber meets the road. That's where you can kind of tell things are real. So for like 3 month to quarter or to half a year, more like investors, if that's your time horizon, daily closes, and really more importantly, weekly closes. So for SPY here, sure, we had the massive green day, but on the weekly, we still have a big old top wick. I want to see where we close. That's going to really inform my bias. What happens tomorrow? So yeah, great question. Great question. That's my small answer, and there's always nuance because these are algorithmic things. It's really tough, but that's a good rule of thumb that'll keep you safe and stop you from panicking. Because I don't know about you, but the amount of times I saw the big candle that ended up being a sweep back below and I sold at the worst time, or it just feels bad. And it's so much better to say, hey, maybe I'll lose a little bit more, but I'm going to make sure that this is real, And if we size correctly, losing a little more to make sure it's real won't kill us. All right, what else do we got here? Chances of 420 test happening on 420. Ooh, very auspicious. Let's see. How far down would it be? 420 is another 20%, and we have 10 days to do it. Okay, that would be scary. That would be scary. I'd have to light one up if that happened. Let's not rule anything out. I think that probably isn't in the cards. But then again, drops happen really fast when they crash, right? So, hey, maybe the universe winks at us and gives us that handle. That'd be pretty funny. Okay, let me read over a few here, see if I can find more. Mean Gene, obviously market conditions are constantly evolving and changing, but is there a hard number or level for any fund, SPY or TQQ, that you think would indicate a market reversal to the upside? So yeah, I think that there are a lot of funds that don't care about this crayon stuff like I do, and they're just looking at PEs and other hard tangible metrics, and they're saying, this is a great company and it's too cheap. I will hold through pain. I know what I'm buying and I like it here. And I think that SPY at about 400 to 420 is going to be a very appealing level in terms of PEs. And I think that there will be a lot of buying there, whether that's the hard bottom, whether it gets there. I'm not going to speculate too much either way. There's a lot of game left to be played, so to speak, but that's what I would say. Yes, there's definitely hard levels. No, I don't know exactly what they are, but if I had to guess, I'd say 400-ish, 400 range. Maybe earlier, maybe like 400 to 430 SPY, something like that. Yo, so happy seeing that I'm watching the same thing as you. Heck yeah, brother. Love to see it. Yeah, and I really rely on my community. I rely on the traders I respect and trust. And it's all about kind of gathering building our bias based on the confluence between good traders, right? That's what we're all about here. So you must be a good trader. That's all I'll say. What impact do you think Paul Atkins will have as the new chair of the SEC? I do not know. I got to learn about what he's all about. I think if he's a deregulatory guy, which I would kind of assume he is, if he's getting in now, then probably bullish. Probably not great for the consumer, but hey, we're talking market here, so probably bullish. But I'll have to read about what he's all about. All right, some thank yous. You're very welcome, everybody. All righty. What is your ideal expiration date for short-term positions? So if I'm investing and I think that the extra leverage is really viable, which isn't a ton of situations, to be honest. The longer I trade, the less options I trade. That being said, when I do, I look for 90-day expirations, 90-day calls, and I'll often do spreads. So a spread is where you buy one leg and then you sell the leg above it. So basically you're saying, okay, I think we're going to go over, let's use Hood as an example. I think we're going to go over 50 in 3 months, but under 60, let's say. So I don't need that headroom, right? I don't need that extra space. So I'll sell that to some degen who thinks that we're going to go double. And hey, maybe we do, and maybe I cap my gains, but that really lowers my cost for entry. And also, if the trade starts working as theta, as time starts eating my contract, I'm actually gaining money because the degen with the higher call, he's losing it faster than I am. So yeah, I like spreads. I like 90 days till expiration. And then sometimes I day trade. If I'm day trading options and I'm really spicy, I'll go 0 or 1 day till expiry, but I wouldn't recommend that. When I do, my stop is $0. Sometimes I'll do stop at 50% loss, but in general, I will only gamble with what I'm willing to lose. And I only do that if I think the trade can go more than 100%. That's a really good rule of thumb. Like, don't take degenerate options if you don't think they can double or triple or quadruple or whatever, because you're basically risking the whole price of the contract, which is like a stop loss at 100%, right? So if it's not 1-to-1 risk reward or more, don't bother. I also will sometimes do weekly or 2 weekly expirations, and usually those are for day trades on, like non-index stocks where there's more kind of wiggle room, or I'm sorry, there's less liquidity, I should say. So it's not like as easy to get in and out, perhaps. So I'll give myself a little more time, and sometimes I'll swing those overnight. Often it doesn't work. So not financial advice, but that's what I do personally. All righty. Got a few more, and then I'm going to wrap it up here because I think I'm probably going over time. But I really appreciate all the support, all of the questions. I love answering them, even the ones that maybe I don't know. I love getting them. So let's see. I'm looking at SPY to hit the 200 moving average on the daily, maybe slightly less before a real bounce and then sideways. So the 200 is up pretty high. I believe it's like way up around here. I could be wrong. I don't have it on this chart. It's quite possible. The range keeps expanding. And what I would say is definitely watch very closely. Definitely watch very closely there. I would not expect it to tag it and then go sideways. I'd expect it to tag it and then have a pretty hard pullback. Even if the bottom's in, we go up to the 200, I would expect a lot of sellers to step back in there because I know I'm going to be short in that handle. So something to consider. Oh, the weekly. So below. Yeah, absolutely. Great call. I am looking for the weekly 200 to tag. As we saw on Apple, the 200 tagged and on the weekly, and we got a really nice rally up from there. So great call. The weekly moving averages, the 200 moving averages of a lot of weekly stocks should be on your radar because, hey, it's the first time that buyers that are that patient to wait for that spot get a chance to buy. Great question. All right. What do you make of the gold rush? Gold, and how high can it go? Let's pull up the chart here. Geez, look at that. I haven't looked in 2 days. It's insane, man. It's so hard. There's a lot of macro factors. Holy moly, what a move. How high can it go? There are a few things we can look at. First off, let's pull back to a weekly. What a chart. As you can see, all my lines are down here. This is where I was trading it. Sad boys. Anyways, I should have just held. Anyways, so what we can do is we can kind of project ranges based on the previous one. So we had this range, and if anybody was tuned in for my last seminar on Bulkowski patterns, first off, if you weren't, go check it out. It's on Trade the Pool's YouTube channel under the live tabs. You'll find me there. Got my pretty face on it. And one thing that we talked about is measured moves of bases. So you have the range that you're trading in and a breakout. You're targeting the two, like basically a double of that. So the 2 fib on this chart. Here, like, heck, what do we do? I don't know. What the heck do we do? Let's zoom out and see if we can find something. Sheesh, what a move. So what we can do is take a fib from here to the top of the base. And look at that. We just tagged the 2 fib on there. So personally, if I was a long-term trader buying in here, I'd be tranching out. That being said, there's a lot of reasons for gold to go up in this environment, right? So heck, I don't know, man. That's a great question. I think we just gotta watch and see how high the moon is. It's a crazy chart. I can't find a single other chart in the market like this. So great question, but I don't know. Yeah, just keep trimming on ATR moves, I would say, and just keep moving your stop on up under swing lows if you're in. If you're in, congrats. Okay, really quick. Bot Yacht Club mentions I haven't gotten to that level of options yet. I'm assuming you're talking about doing spreads, which is I think level 2 or maybe 3 options. This is super. This is a one bone I have to pick with exchanges, because the tools that keep you safer are behind access restrictions, right? That's not cool. I don't like that. I think that if you're allowed to trade options, you should be allowed to mitigate your risk with other options. You know, that's just me. Alrighty, what else we got? I think we're wrapping up here. Yeah, it looks like that's it. And I'm going overtime. So we're gonna wrap it up here. Thank you guys so much for joining. I hope this was informative. If you like it, give it a like and a thumbs up. And what I will do is I will post my new Discord, a new link. I didn't realize my Discord link expired. I will post a new link as a tweet, and I will pin that on my profile at Justy Trades on Twitter. That's I might change my handle now that I'm going by my real name and doing big boy analysis. But thank you so much. I would love to see you in my DMs, in my Discord server. We have a good time, and they're great people. So thank you guys. Have a great day.